Is demand for Treasury bonds fading? The US Treasury just tried to sell another $44 billion of 7-year notes, and the auction flopped hard. GDP also came in surprisingly hot, while the housing market shows significant declines in some regions. So, GDP, gross domestic product, this is the aggregate output of the US economy. Now, there's two ways to look at it. There's inflation adjusted, and that is what we're looking at here. And then there's nominal. First, we're going to look at real GDP because that is the data we got this morning. Came in surprisingly hot at 3.3% annualized growth rate. The expectation was 3.1%, and the original print, there are revisions with GDP. The original print was 3%. Now, 3.3% is a notable reversal from the first quarter, which, by the way, most people will remember was negative, indicating at that rate, if the US had kept those economic conditions, the US economy would have been shrinking at 0.5% per year. However, a lot of the conditions that led to that negative GDP print were just kind of tariff related noise that ended up reversing and therefore dragging GDP much higher. And by the way, if you had been listening to CNBC, they were telling you back in May that a recession was coming. If you were following our channel, we were saying nominal growth is about to make a major reversal. And sure enough, that's what we are seeing. So nominal growth, what is nominal growth? So you just add real GDP. We established 3.3% annualized growth rate. You add that to inflation. And here we're just looking at headline CPI. Well, you add the two of those together, 3.3 plus 2.7, and you get 6%. Now, if we go back to the nominal growth rate back in March for the first quarter, what was being indicated back then? It was about 2%. So we went from 2% nominal growth to 6% nominal growth. And if you look at where 6% is relative to the post GFC era, it is kind of near the upper end of the range that nominal growth has been kind of bouncing between. So, why that matters is the debt. So, of course, having a view on nominal growth, you have to have a view on inflation and real GDP. But outside of that, you also have to understand the debt dynamics. So here we can see debt to GDP up top in blue. And then down here, this dotted red line indicates 0%. We're looking at the cost of the debt, the interest rate on the debt, here, the 10-year yield, and subtracting nominal growth. And so what you can see is that generally speaking, when the cost of our debt is below the nominal growth rate, debt to GDP declines and the debt is not an acute issue. However, when the cost of your debt rises above your nominal growth rate, as we can see post 1981, this period of time, the cost of our debt was above nominal growth to a significant degree, especially here in 81. It was 10%. The yield on the 10-year treasury was 10% higher than the nominal growth rate. You can see what happens to debt to GDP. So the debt situation becomes much more acute. Now, this particular data set down here is using a bit of a lagged GDP input. If we use the data that we just went through here of a nominal growth rate of 6%, well, the 10-year treasury is trading at 4.2. So the government has managed, at least so far, temporarily, to get the cost of our debt significantly below nominal growth. Now, one of the reasons we called for a reacceleration was there was a concerted pivot within the administration back in March, April, May, that Doge was kind of out the door. We're not going to try austerity any longer. We are going to run it hot. Well, this is what run it hot looks like. You can see that real GDP has definitely reaccelerated from the negative print that we had that first quarter to a positive print of 3.3%. Now, they note that the BEA notes that a large amount of this was due to a decrease in imports. Imports are a subtraction in the GDP formula. They also note an increase in consumer spending, which we'll take a look at both of those in a second. Here are the contributions to the change of real GDP. And you can see imports, the import-export story is really what is driving this reversal in the GDP print. We will also look at personal consumption expenditure and consumer spending, but really the story here and the reason we called for a reacceleration of nominal GDP was both that inflation is likely headed higher. I will link that video that I did a couple months ago. I will link that at the end for the inflation piece, but also real GDP. Just look at how GDP is calculated, read the BEA reports, see that it is due to a surge in imports like we saw ahead of the tariffs, and go, well, that's can't continue forever. Eventually that's going to reverse. Sure enough, it did, as we can see. Well, just as it was a drag on your GDP as the imports were surging relative to your exports. We can see, for example, here in March, our balance of trade, we were running about $138 billion trade deficit per month. Well, fast forward just 1 month. To April, and you can see that that decreased notably, and it went from 138 billion all the way to 60 billion. So that is a sharp reversal of like $80 billion per month reversal in the trade deficit. So as the tariffs kind of work their way through the system, as corporations, start kind of adjusting, and the U.S. economy starts adjusting to the tariffs, we will see where this balance of trade settles out. The idea that we're going to meaningfully improve the balance of trade in a short period of time, this is a multi-year, even decade-long goal to improve this trade deficit currently running at $60 billion per month. Now, the BEA also noted PCE. So, what is PCE? This is personal consumption expenditures, basically exactly what it sounds like. And in red, in this line here, we're looking at the nominal figure. So this is not inflation adjusted. Just think about this for a second. If costs are going up at 10% per year, then nominal personal spending, nominal personal consumption is going to probably increase around 10% because consumers are paying 10% more money because costs have gone up 10%. So this is not adjusting for inflation. When you're talking about a nominal figure like PCE, it is not adjusting for inflation. And we can see that it has been headed up and to the right kind of relentlessly. Well, once you adjust for inflation, here we're looking at real PCE. This is nominal PCE divided by CPI, as we can see there. This peaked back in December of 2024 and has been declining ever since. So, sure, consumer spending is up in a nominal way of looking at it. And some of that is driven by inflation. But once you account for that inflation, you can see that real PCE has not set a new high going all the way back to December of last year. So we also got home sales data. Here's both pending home sales on a month over month basis came in negative 0.4%. There's a lot of data with monthly data releases, as we can see here. So not too much signal there with the monthly data print, but existing home sales, just zoom out and look at how many homes are transacting. We can see that the number of homes transacting in the housing market currently is near levels not seen since the 2008 GFC. We've done videos on the state of the housing market, why it is the way it is, where you have the average price increasing and the average mortgage size declining. I will also link that at the end of the video, but suffice to say, the housing market is nearly frozen. However, that does not mean you're going to get a nominal US dollar decline nationwide. So here are the regions from the NAR report. We can see that the Midwest saw a 4% decrease in home sales on a month over month basis. And if you look at the West, they saw a 3.7% increase month over month. Now, I'm in the West and it's been quite hot. Maybe that is a weather story. I'm not sure. So we also had the 7-year note auction. So we covered the 2 and the 5-year yesterday. This is the 7-year. Here are the results. The high yield was 3.925. When issued, that is what is the yield going into the start of the auction. That was 3.922. Well, this is lower. So what that means is that it tailed. Remember, a tail indicates weak demand. A stop through is the exact opposite. This is where there is so much demand that the at the auction, the buyers are willing to accept a higher price or a lower yield, because remember, they are inverse to each other. That will show a stop through. That is a sign of very, very strong demand. Well, similarly, a tail, which is the opposite, which is where the Treasury must sell the bond at a discount, or put another way, a higher yield than it was trading going into the auction, which is when issued. that is called a tail, and that indicates weak demand. Now, we also had bid to cover. This came in notably from the prior 7 year note auction last month. Bid to cover, this is the total amount of bids divided by the total that the Treasury is trying to sell. We can see the bid to cover is 2.5. Now, the higher this bid to cover is, the stronger the demand. However, the last month's 7 year note auction bid to cover was 2.79, indicating that demand for the 7 year note is fading, at least compared to last month. Now, the US Treasury sold $44 billion of these 7 year notes. Andy Constant, kind of a veteran bond trader on Wall Street, gives each auction a rating, and he gave this rating a C minus. So the demand for the 2 year that we covered yesterday, the demand for the 2 year auction that we saw earlier this week was quite strong. The demand for the 5 year, however, was quite weak, and I think he gave the 5 year auction yesterday, I think he gave it a C. This 7 year note auction, as you are going out in duration, you can see that they are getting weaker and weaker. This is especially true for something like the 30 year Treasury bond. So just a look at the Treasury yield curve again. Since the Fed started to cut rates, we're in a rate cutting cycle, an easing cycle. Since the Fed started to cut rates, the 30 year yield is up about 90 basis points. The 10 year is up. Most yields across the curve are actually higher than they were when the Fed started to cut or reduce interest rates. This is called a bear steepener. Now, there's some amount of, over the past week, over the past month, in the near term, in the short term, in the recent history, there has been some degree of bull steepening, which is generally what you see. It's the opposite of a bear steepener. This is where, because the bond market is expecting Fed rate cuts, they are buying the short end of the yield curve, say the 1 year or the 2 year. Those operate much more off of, what is the Fed doing? What is that overnight interest rate? What do we think that overnight interest rate is going to be over the near future? That is what the 1 year and the 2 year operate off of. Well, the Fed, Jerome Powell, at the Jackson Hole speech on last Friday, signaled a September rate cut is very much a possibility if the data supports it. Now, we get PCE data tomorrow. We'll do a video on that as soon as that comes out. So we'll have to wait to see, because inflation is starting to pick up again, as we have been calling for. And as we have been seeing with the data, core CPI is running at 3.1%. And we're talking about the Fed cutting interest rates. So the long end of the yield curve, we addressed what drives the 1 year and the 2 year. Sure, those rates are coming down because the bond market is expecting the Fed to lower rates. But when you talk about inflation, when you talk about core CPI running at 3.1%, and the Fed seriously considering Fed rate cuts, the 30 year yield is much more representative of that concern, the fiscal concern. Now, it's not just in the US. Long-term rates are heading higher kind of all over the developed West, especially in France and the UK. So we're keeping a close eye on the French bond yields, as well as the gilt yields for the UK. So this is not just isolated to the US, but fiscal deficits and the debt, and some of those sort of dynamics are going to impact the long end of the yield curve much more than the short end. So right now, over the past month or week, or even 2 months, you have short-term rates like the 1 year, the 2 year. You have those rates coming down because the bond market's expecting the Fed to cut rates, and the short end of the yield curve operates based on, what is the Fed doing? What are they going to do? What are they signaling they're going to do? However, the long-term rates have headed higher. Again, long-term, you have the 30 year yield up by 90 basis points, even though the Fed has reduced rates by 100 basis points. This is much more of a concern. This is operating on a different principle than the short rate. The short rate is anticipating what the Fed is going to do with that overnight interest rate decision. That is why the 1 year and the 2 year are setting lows going all the way back to May, is because of that expectation for a Fed rate cut. However, the 30 year and to some degree the 10 year are going to operate on much different principles. Those, you're going to see the fiscal concerns reflected there. You're not going to see fiscal concerns reflected at the short end of the yield curve. So, kind of have a situation where the long end is operating off of totally different concerns, fiscal, debt, inflation, but then you have the short end that is, those rates are coming down, and that is because the short end behaves off of what the Fed is going to do, what the Fed has indicated they're going to do. And for some reason, with core CPI at 3.1, the Fed is talking about cutting the overnight federal funds rate, which we see here in white is running at 4.33%. So because of that, the 1 year and the 2 year, the short end of the yield curve, those rates are coming down. But again, for the average American that wants to buy a house or get a car loan or even a credit card interest rate, those are not priced off of the 1 year treasury or the 3 month treasury, certainly not the overnight federal funds rate. They are priced off of the 10 year or even the 30 year, which again are behaving on different inputs. They are responding to different things. They are worried about different things. The long end of the yield curve, again, not just in the US, kind of worldwide in the developed West, is worried much more about the fiscal health of the UK, France, the US, and inflation, and the likelihood, by the way, of financial repression, which is negative real rates, which is where you are capping, you are running inflation hotter than the interest rate on the debt. You are suffering, you are causing or forcing bondholders to suffer a real loss in inflation adjusted terms. If you buy a 30 year treasury at 4.88, but inflation runs at 5.88, that is financial repression. That is negative real rates. That is what the long end is worried about. They see the debt situation of the West more pronounced in certain countries like France, the UK, and to some degree the US. They are seeing that fiscal concern, that fiscal health, that debt picture, and that's why long end rates are higher. This is reflecting term premium or the premium that the bond market is demanding to buy longer duration debt. Now, it's important to mention that the yield curve steepness, this is simply the difference between a long term interest rate and a short term interest rate. We're going to look at that here in pink. The yield curve has been steepening. And again, generally, if you look at the Fed rate cutting cycle going back to September, it is what's known as a bear steepener. But the yield curve is steepening. The gap between the 30 year yield and the 2 year yield, now at 1.24%, that gap has been growing wider. Well, we still have a long ways to go. If you zoom out and look at this spread, say in the early 2010s or especially in the 1990s, you can see that the spread between the 30 year treasury and the 2 year treasury, which is what we're looking at here in pink, that spread was as high as 3.8%, meaning 380 basis point higher yield on the 30 year than you would get at the short duration. So we can see that while the yield curve has steepened significantly over the past 2 years or so, it is still nowhere near kind of all-time steepness if you look at back in say the early 2000s. So the yield curve still has a long ways to go when it comes to the shape and the spread. As you can see here, when the 30 year treasury yield was about 4% higher than the 2 year, you can see that reflected a different way. See, the purple line is the 30 year yield, and the orange line is the 2 year yield. You can see the gap between those is growing wider. That is what we are talking about when this pink line is going up. It is simply measuring the gap between long term interest rates and short term interest rates. That is what a steeper yield curve means. We can see the yield curve went from being inverted, which is very abnormal. This is where you get actually higher interest rate at the short duration. This is very abnormal, not how it usually is, instead of the long term treasury bond. So that inverted curve, of course, uninverted. A lot of people said that is indicative of a coming recession. In 2022, we never really got a recession. There were 2 consecutive quarters of negative GDP, and we did have a bear market in the S&P 500, but we didn't get an official NBER defined recession. There are dynamics going on with this spread, this particular spread. You have the Treasury Department that is not issuing as nearly as many long duration bonds as they used to. Well, if you keep demand for say the 30 year constant and you reduce the supply, kind of mechanically, you are going to artificially boost the price, or put a different way with bonds, decrease the yield. So there's kind of artificial, Michael Howell says, not QE, QE, not yield curve control. Yield curve control, that is what he is referring to as some of these activist treasury issuance dynamics where the or excuse me, the treasury is shifting around the way that they're issuing the debt by decreasing the amount of long-term bonds they are issuing and shifting all of that into short duration bonds. Now, I did want to point out, just for comparison, we generally don't cover it, but here is the 4-week bill auction. So we had another auction today. The bid to cover 2.68. We sold $100 billion of 4-week bills. Now, remember, we sold $44 billion of 7-year notes. So you can kind of see that dynamic reflected there. We are issuing an insane amount of short term bills. Now, remember, what this means is that you are kind of tying the hands of the Fed, because if inflation starts to reaccelerate and you need to roll your debt every 1 month, 3 months, because you're issuing only short term bills, then you tie the hands of the Fed. If inflation starts to pick up again, the Fed can't really raise rates because it'll blow out the interest expense. So, this Fed independence story with Lisa Cook, while it's legitimate and worth talking about, the Fed's independence has been being eroded for years already. Again, prior to this administration even coming in, due to what Secretary Yellen under the last administration was doing with this, what was termed activist treasury issuance or reduction in duration issuance, and shifting all of that debt issuance into short-term bills. The hands of the Fed, or Fed independence, has been being eroded for years, long before all the drama recently with Lisa Cook. So anyways, hopefully that was helpful, and I will catch you in the next one.